Hey YouTube, it's Dimitri, and today we're going to talk a little bit about causality and interpretability within the machine learning space here. So I was recently at Columbia University for their Masters in Financial Mathematics conference there, talking about this on a panel with some other really interesting and bright individuals from across the industry. And we were getting going on this, and right before the panel discussion, I had a great conversation with a student as well who was asking, like, what are you talking about? And how do you do this? And like, wanting to get into the details. And often I don't know how to present these ideas fully until somebody starts like pulling out of me like interesting questions and digging deeper into these topics. So I thought I would take a few minutes just to kind of share my thoughts and how I view this and why it's important. Because often we end up with the very overly hand-wavy hype machine learning space where it's like, nothing matters. Machine learning's amazing. It doesn't matter if it works or not. There's no consequences in the real world. And then the reality hits you and then you have no job and yeah, life sucks. So you have to have all these components of explainability in models, especially in the finance space here. And let me get into why this matters here. So to start with here, what is interpretability? What is causality? Let's start by thinking about this as some sort of spectrum here. So defining our number space or our intellectual idea space here. On one hand of this, think about like we know absolutely nothing, right? We run a model, we fit a model, and I just don't care, right? I know absolutely nothing, and that's okay. That's on one far spectrum. And then on the other extreme spectrum, we do absolutely everything. We know it's causality. It's a guarantee. The relationship is there. And this is the fairyland, which is it doesn't actually exist, right? We can know nothing, but knowing everything is just not possible. So you have this spectrum here, and starting with statistics, you think about, okay, everyone complains like, Dimitri, these tests, they don't guarantee me everything. And so I see people continually griping and complaining like about p-values or f-tests, or like Granger causality, for example, in time series. And they go, well, it doesn't really matter, right? None of these tests are meaningful. They don't guarantee me anything. And so this mentality that typically comes from the machine learning space, the AI space, the data science space, typically spaces outside of econometrics, finance, traditional finance, and statistics. So those are kind of the core foundational principles in physics as well. Physics is hard based more in a scientific approach. But you have this spectrum and you think about like a p-value doesn't guarantee you anything. Nothing's going to guarantee you everything. But you shouldn't just throw everything out the window because you don't hit a guarantee. When in that spectrum, you could end up somewhere in the knowing space. And that's what statistics is. That's what econometrics is. Other sciences as well. Is it's using the scientific approach to get towards some sort of understanding, interpretability, and meaning here on this spectrum here. So understanding something in the middle, like I know when these things change, this is about what's going to happen. And so on that spectrum, instead of doing black boxes, I'm just fitting because I want to fit. This is where hedge funds blow up or banks and firms blow up consistently because they don't have an understanding of anything. You need to do all this sort of testing here to get to that. This comes in an academic kind of perspective as well on the quant space. Like people complain and go, oh, you don't really need a master's or a PhD. I'm plenty smart and I took these 4 or 5 classes that they offered in grad school, so therefore I'm smart enough. That's where that spectrum kind of plays into here, is that when you graduate, even with a master's or PhD, you don't know a lot, but you need enough tools to start getting towards the other side of that spectrum here of interpreting and knowing something here. Now, interpretability and causality are challenging things because causality and correlation typically get thrown out as a discussion point a lot, right? In finance, everything is correlated. Like there's lots and lots of things that are correlated. And again, we talked about in this panel discussion is A causing B because sometimes it seems like B is now causing A. So the timing of the correlation also is a challenging piece of A and B and how they're actually related. And I think there's kind of 2 approaches we currently see with interpretability, and it's trying to understand the relationship, right? We're trying to understand, does one thing cause something else? And we're trying to do some sort of prediction here. And then in the interpretability piece here, I think it's going to come in the business stance of understanding how do I change my behavior to get better results? So how do I interpret the model, and does that make sense? And does it give me something I can actually do to get a better outcome? If we're just, taking the world as the world is, I mean, sure, maybe you can say it's like gambling or prop trading. Like if a price is what a price is and it comes out of a black box, I don't care why or how it works. I'm just going to trade off of it. But the reality is markets move and then you fail. And then the human nature is trying to understand why did it fail and how do I prevent that failure from happening in the future so I continue on my business of making more money on the prop side of that. Now on the business side of this, right, this is where interpretability I think is a critical piece, which is going to be, I build a model, but I don't build a model for me, not for me making any sort of decision. I'm building a model for an end user here, right? Now we think on the investing side, so the portfolio manager and the trader. I work in the subprime auto space. So we generate capital and technology for subprime auto. We make models both for originating loans through dealers, so indirect financing. And more or less, we also sell models as a service to a dealer, and then that dealer uses the models to make some sort of decision here. Now, the piece with the model is when you build a model for somebody, they want to know what can I change to make the outcome better, right? No, that's a challenging piece, and you sell models as a service because you don't want to give away your secret sauce, right? You're modeling, dynamics and how things work and the variables that go into it. But also from an internal stance, I have to get buy-in from the business to use the model to say this is the proper price and this is why. And also most models have some sort of levers that you want built into that, right? So you think about like a loan. Let's take an auto loan, for example. If I change APR, what's going to happen to the probability of default, or maybe a few layers away, what is going to happen to the return on investment, right? I give out this money as a loan. Loans, hypothetically, you could say, oh, make all the payments and you get X amount in interest and you can just do a calculation. But the reality is there's probabilities. Like the customer most likely will not make all those payments. So there's a probability of default. Then depending the timing of where the default occurs, that's the exposure at the default, the balance of it. And then the loss given default's the probability I can collect off of that, because most likely I'm not going to collect the whole thing. There's repossession fees. Maybe I just don't collect the vehicle, which is a possibility. Maybe the vehicle's damaged. We don't get returns. There's a whole bunch of other issues that go into this. So again, when you build out this model, you need some sort of interpretability of like, what can I do? Should I change the loan structure? Should I change some sort of dynamics here to reduce my risk and increase my profits, right? There's all these kind of dynamics in play. And if you don't understand the model, you just say, oh, it's a black box. There's no understanding, there's no interpretability. You don't need to understand it. No one's going to use your models. So it's a very arrogant position, I think, from machine learning, quants, math, stats, like econometrics, like any sort of field. You have to have some sort of buy-in for someone to use that model, and getting that understandability is a crucial piece of that. Now, the other piece is when we start to say interpretability, people say, oh, Lyman Shap, right? Oh, those are great, right? What is the contribution to this model, right? These variables, let's say you have 10 variables, they each contribute X amount of percentages, and therefore I understand the model. No, you really don't understand the model. They're fairly weak tools. Now, again, I would say it's the spectrum, right? We still run them. We still look at them. We still try to understand them. We're trying to get some better grasp of what's going on within these and how do we team these up with other sorts of tests and looking at residuals, for example. But one of the hard parts is imagine it's a number space. So let's go into pure math world here for a second. You have a number space. Your data sample is a smaller portion of that. So I'll give you an example of the stock price here. The stock price can't go below zero, hypothetically. So you'd say the number space ends at zero. Anything above zero is possible. Anything below zero is not possible. Then you'd look at your stock and say, okay, the stock price has gone to $90 in the past. Let's just say 150 is what we think the maximum would ever be in our time frame that we're considering here. And that's what we're going to look at and we're going to model within this space. The reality is the stock could go to infinity. Right? I mean, like Nvidia and Tesla have been crazy the last few years here. Other sorts of stocks have crashed, right? Companies have gone bankrupt. They've plummeted. So getting that number space dialed in is a critical piece here. Now, within financial markets, you think about a stock, they don't start at zero, right? They go through an IPO and an IPO comes out and says, oh, per share, let's say it's $25 a share. And then you watch that price move over time as the firm, makes good and bad decisions and profitability and cash flows are measured that are coming off that firm. And you watch them and you say, okay, I think this is a good investment. It's going to go higher or lower. And so people make some sort of investment decision on this, right? So you think about this and you think about, okay, if I had a model let's say it had 10 variables. It said, this stock was going to go from, I don't know, $90 to $105, and it's got some sort of space that you're modeling in here. Again, the problem with machine learning and the problem with these metrics here is knowing the weights of those doesn't tell you the relationships, because we're not actually modeling the relationships, especially when you have decision tree models, which is where these are typically used. For example, like gradient boosting decision trees, random forests, even just simple cart models. You're only looking at a very specific case scenario, if this, then that, right? You're narrowing down these little pockets in this space, and you're saying the average value of these variables, combinations of variables, gives you some sort of set of data. You take the average of that, that's the prediction of a decision tree. Now you can get into more complicated versions. You like random forest, you have multiple decision trees and you're averaging. And then interpretability is much, much harder. But the reality is that they just tell you a percentage. As the stock market changes and moves, and as the economy changes and GDP moves, and all these dynamics are moving around with the economy and the competition, so you have to think about competitors of this stock. You think about similar stocks and people within the same industry, and there's all these dynamics. As they change and move, those values will drift and move around, which is why you see so much ridiculous emphasis on drift monitoring with machine learning. It's because they don't know what's going on. They built a rigid piece of glass, and as soon as a little pebble hits it, it shatters. So bad modeling practices. Don't track just drift of everything and inputs and outputs. It makes nonsense. But it points to the issue here, which is you can't use something simple like Lime or Shapley to get some sort of weighting here. So this is where you start to see, when you go back to traditional statistical methods here, when you have a linear equation, you have a coefficient. The coefficient itself isn't an estimate of the prediction. It's the estimate of the relationship between what you're modeling in that variable itself. And then when you do multiple variables in this framework here, you start to end up in a more complex framework, a multi-dimensional framework here. So again, estimating those is more important. It gives more insight, because when you start to think about this, and this is where we came into the discussion of interpretability, when a user uses a model and they say, okay, if I want to increase APR by 1% or 2%, what happens to that probability of default? They're expecting in their head some sort of monotonic relationship. More specifically, they're expecting a linear relationship. Humans aren't that smart, let me tell you, myself included. It is very, very hard to think in multi-dimensional spaces to start with. So when you have multiple variables within a model, and then when you think about nonlinearities, imagine, and I can tell you APR probably is not linearly related to defaults here. So as APR increases, the probability of default actually spikes. You have a convexity into this. You have a curve where when you increase APR a little bit, and it's very, very small, like 1-2%, you don't impact the probability of default very much. But as you start to get into like 10, 15, 20, depending on consumer grade and all this, you'll see the curve itself starts to spike because that payment is becoming too high for the consumer. There's almost no way they can make that payment, even if they can float it for a few months here. So that gets into the nonlinear space, which is one of the advantages of using machine learning. But that gets into thinking about, should you just do transformations of nonlinear relationships into linear relationships and then put this into a modeling framework? Again, it seems interpretable, but it becomes a little hand wavy because you say, well, like x squared. So APR squared gives you some sort of linear relationship, maybe with APR. And then you feel really happy and warm and fuzzy, but trying to interpret in your head, like where on that spectrum you are on APR and how that is going to change. It's like getting into derivatives. So sensitivities. It's a more challenging thing to kind of look at here. So that is another piece of that. To wrap this up, the conversation I had with the student was talking about how do I go about this in practice? Because it sounds like it's pretty hard to get to interpretability. It does sound like it's a requirement for many fields, especially in the financial space. And how do we do something meaningful? One is how you build your models. So first off, when I go to build a model, I sit down and talk to the business and figure out exactly what they need here. Don't go out and build something crazy for the sake of it. Figure out what they need. And then I will go and I will run correlations, simple correlations behind the scenes. I will end up taking a list of all the variables we have. We try to narrow them down. It depends on the problem. Some problems I have 30, 40 variables. Some problems I have 2,600 variables plus, something like that. But I will get lists of variables that seem fairly reasonable, and I will give them to a few different people on the modeling and the business space here. Because as I've learned in a career, you need the business to have buy-in in the model, and they need to know, conceptual soundness. So like if APR goes up, probability of default should also go up. If that relationship is backwards, it doesn't make a lot of sense. But I have found that business professionals in the financial space specifically can explain the relationship both ways in most cases. They will come up with some scenario, some sort of justification, and they can say like, oh, it should be a positive relationship when one goes up, the other goes up. They can also explain it often in the opposite, when one goes up, the other goes down, and that makes complete sense. So the way I get around this bias here a little bit with the developers, I run all the correlations. I don't show them anything. I give them a list of the variables that are potential variables. I try to give them a slew of variables, not just highly correlated, but I throw in a bunch of uncorrelated ones as well. Get it to something meaningful they can look at quickly. Maybe take 10, 15 minutes of their time. And I give it to at least 2 people, 2 to 3 people in the business, and I have them go through and I tell them, please don't talk to other individuals doing this. Go in with a highlighter, right? And highlight the ones you think are meaningful that you would expect to be in this sort of model here. And that brings in the business expertise and the business insight here. And this helps me get around issues of correlation. So often I've had models where things are highly correlated. I had an interest rate product that's related to real estate. The company dabbled within the commercial real estate side. And 30-year was just really, really, really predictive. And I was like, all right, this is going to be awesome. I'm going to throw this in there. And I went and talked to the business, and they said our average duration is actually commercial real estate, not residential. And that duration for those loans there are going to be 10 years. So again, the 10-year interest rate is going to be multicollinear to the 30-year, so you can't put both inside the same model. That was one issue. But second, I chose the one that was not very correlated. So 30-year was extremely correlated. 10-year is a little bit correlated. We put the 10-year in because it made more business sense to make a more robust model. Right? You have to take in the expertise of the business into the modeling framework. And that's what makes really good and robust models, because even though something is highly correlated in a snapshot or a window or development or training data that you have, having the business insight, having the intuition from the business helps you build better models. Often it will actually make me struggle with the model development process, because looking at high correlations, I could knock out a model, especially in the machine learning space, very fast. But then they break very quickly because the relationships aren't actually there. So that is one way we get around that, right? We bring the business in and we do that. The second piece is then I take my data expertise and I look at the data and I look at the variables that the business has recommended, and you have to learn how to artistically blend them together. So quant is not always hard science and like math and like you follow these sorts of logic. You use a lot of these statistical tests and data, and we're looking at all the different relationships, and you try to estimate the relationships accordingly, right? So they're properly done with robustness. But at the same time, you need to bring in that business expertise. And that is one way that we get to better interpretability. Now, also there's a buy-in piece to this, right? I will tell you, if you build a model and it makes no sense to the business, but it is extremely accurate, they won't buy into it. And often they will have to use it for some sort of time period to really show them it works. And there are gambles you can take in that space, but often getting the business to buy in and use a model is more important than the accuracy in itself. So I would encourage you guys to actually look at that, because it's been much easier in a career to go back and say, here's a model we built. We talked to you guys at the beginning. You explained the problem. You look through some variables. You're spot on. You guys know exactly what you're doing. You're doing a great job here. Pat on the back. These sorts of variables made it into the model. Again, I already know this. I've been building models, you guys, for over a decade now. I know it's going to come into the model most likely. There are always a few surprises, but for the most part, I understand about what's going to come in. And so you sell it to them, and you do this pitch, and you get the buy-in on it, and they're really excited, and they're into the model. The worst thing I can tell you on the quant side and the interpretability side is when there's a lack of trust between the development teams and the business side, and you're constantly feuding and fighting. When these sorts of environments happen, it's often best just to leave these firms. But at the same time, it's on the quants a lot of times, and machine learning and data science people, to build that sort of trust and that explainability piece, which goes a long way, which is just one more reason why you need interpretability in machine learning and data science and statistics and econometrics and physics and everything else here. So the world is quite complicated. Coming up with justifications, coming up with meaningful models is important. Again, looking at point estimates versus relationship estimates are two very different things. Building robust models often require the proper estimation of relationships, not simple kind of set in stone point estimates like a decision tree, which often when they're overfit, the number space or the space for the estimation, the sample in each leaf becomes far, far too small to become something reliable and robust across time. So anyways, thanks for listening. Thanks for watching. And as always, until next time.